We'll begin. I've structured this presentation to give you, first of all, it's entirely general. So nothing contained herein should be taken as specific advice. Everything is subject to your personal circumstance, and please seek professional guidance before implementing any of these ideas. I did try and structure this presentation by first talking about a little bit of background, explaining a little bit about tax deductions, things that I suspect most of you don't know or haven't really studied, and it'll give you good context when discussing deductions. So we'll go through the Internal Revenue Code, and we'll talk about two cases that are of interest, and then we'll go through some deductions that I'm hoping will be of interest. So let's begin. First of all, what is the concept of a deduction? And it's interesting. It says Internal Revenue Code 162 describes any expenses both ordinary and necessary for the production of business income. There's really three key components there. They must be ordinary, they must be necessary, and they must be for the production of business income, should be deductible. So these are completely dependent on your business and your circumstance when defining ordinary and necessary. I have clients, for example, in the entertainment world for whom every concert and every Netflix they download is deductible if they're part of a guild, or if the experience is necessary for them to produce. That wouldn't necessarily be true for you, but there are things in your lives that are deductible that are deductible for you just because of the work you do. So ordinary and necessary for the production of business income is the code. That's the guide. Judge Learned Hand, it's a great name, easy to remember. I'll read it because it's pretty valuable. There's nothing sinister in arranging your affairs to minimize tax. Everyone does it, it's encouraged, it's allowed. The courts have actually literally said that you are encouraged to, you are allowed to, it's completely permissive to enter into a transaction for the purposes of tax benefit. So it's interesting. That's not true in all countries, by the way. For example, in Australia, that's actually the opposite. But Judge Learned Hand's case is famous. It's necessary to understand when defining or engaging in business. It is allowed. It's not sinister and good authority. This final case, before we get into some specifics of deductions, is the Hill case. It's a fascinating case. It's a teacher in Virginia whose qualifications lapsed. She had two options. She could have sat for an exam, which would have been completely and entirely free, or she could have taken a course at any university. And she chose the latter, but she didn't just choose any local community college. She actually traveled to New York and took the courses at Columbia University. And it was challenged. And the case basically, the tax court ruled that it was not deductible because there was a cheaper way for her to re-credential, re-qualify. She could have taken a free exam. And there was this middle road where she could have gone to the local college, but she took the most expensive method imaginable to re-qualify. And at the Supreme Court level, it was ruled that this is completely allowed, completely allowed. There's nothing, the United States government, the Internal Revenue Service has no authority to tell you what's a reasonable expense when it comes to amounts. Let's take an example relative to vehicles. If it is deemed that your car is deductible, there's no statute which requires that you go out and get the cheapest Prius you can find. In fact, you can drive any vehicle so long as the use is business related and the need is there. There's nothing that says that it can't be a $100,000 car. So this case is a very, very interesting case. When you go out and buy an X-ray machine for your office, the service is not going to tell you that there's a cheaper machine to get. It is simply, the question is it ordinary and necessary for you to do your job? If the answer is yes, then you can take the deduction. So with these three pieces of background in mind, we'll jump into a bunch of specific deductions that I think you'll find of interest. I do encourage you to please ask questions. Thank you for asking questions. I did want to make this interactive. I'm here, available. Can we start with just a show of hands, which is how I start every single one of my client meetings, is who in this room has a will and a current estate plan? Both. Does anyone? Okay, so it's a pretty good ratio, The problem is that there's actually 100% of you in this room have a current will, 100% of you. And this is not tax related, but something you should know, that if you die without a will, you're dying what's called intestate. And the state of California will take it upon themselves to dispose of your assets in accordance with the legal system here. So if you don't want to defer your last will of testimony to the state of California, you should call up your estate planning attorney, something I do not do, but I encourage every one of my clients to do, and update your estate plan. That's sort of everything else we discuss with my clients is secondary to their estate planning needs, which I don't handle. So I would encourage you to make sure your wills are current as sort of a basis for your tax and financial planning matters. Okay, jumping on here. Captive insurance is a pretty interesting concept. I want to explain this to you by basically, in full disclosure, I've actually never been able to effectively implement this for my clients because the circumstances necessary for it to work are somewhat unique, but it's a pretty incredible mechanism. Basically, in 2016, you can pay. Really, the corollary is the captive insurance company can earn $1.2 million of premium and not pay tax on that. So you can, from your corporation, incur a completely legitimate insurance premium expense, pay it to a captive insurance company that will receive that full deduction, and because of this interesting set of rules that apply to insurance companies only, that $1.2 million becomes a deduction for you and not income for the insurance company. Does that make sense? So you basically created a deduction up to $1.2 million. It's going up to 2.2 next year. It's a pretty wild opportunity. The interesting thing is that it's actually a true bona fide insurance company that is being established. You can own it, so the proceeds will ultimately inure to you or your kids or your grandkids, but that income is completely tax-free. Because it's a true insurance company, it has to have actuarial risk of loss. And we can find actuarial risks that you are exposed to and insure against them. There are some nuances. There have to be 7 or more entities. Each entity has to receive between 5 and 15% of the premium allocated. It would work if you have family or friends who have similar risk exposures and wanted to do this together. And one cautionary tale is that you can find captive insurance companies that will pool you with unrelated parties. I would just caution you that although these risks are generally you try to create esoteric risks that aren't likely to come to fruition, if you have sort of unrelated parties who have risks beyond your control, your capital is pooled with theirs and subject to their claims. So it really works better if there are 7 related entities that you can sort of, you know that the other 6 are not going to file a claim and you're going to be at risk of loss. When I say no, I mean actuarially likely that that's not going to happen. Because again, it is a real insurance company. They have actuarial filings, tax filings, but it's this fascinating opportunity where you can deduct up to $2.2 million next year completely tax-free. And it'll sit in the C Corp and grow and grow and grow, and it'll ultimately pay dividends to your kids and grandkids in years to come. And it's pretty wild. So I just wanted to throw that out there and caution you to not jump into one of these unregulated pools where you don't control all of the risks. Yes? Captive insurance, again, is when you are actually forming an insurance company, collecting premiums from your dental practice. Your dental practice will deduct the expense as a premium. That new corporation that you're forming will collect the $1.2 million of premium but not pay tax on it. If it had collected $1.3 million of premium, it would collect tax on the additional $100,000 because it's only the first $1.2 million of premium that's tax-free.
Even from patient?
No, from your corporation. So you have terrorism loss.
So we own the insurance.
You own the insurance company.
So it's like it's your own.
It's your own insurance company. Yeah. So you could, but you have to have 7 entities. So go find 6 people in this room right now and form your own captive insurance.
7 entities can it be from the same family with different LLCs?
They can be, but they have to have true risk of loss. Yeah, they can be connected. They don't have to be entirely independent. But they each have to have a true risk of loss. So it can be terrorism risk, which is, you can calculate the actuarial risk of loss and apply a premium and go from there. You can create your own insurance company where you collect the premiums and you're the owner. and it's collecting premium from your dental corporation, and that dental corporation is paying premiums to your insurance company, and you're taking the deduction here and not paying income tax here, because insurance companies are allowed to collect 1.2 going up to $2.2 million of premium and not pay tax on that.
And then ultimately what happens to the county?
It sits in this corporation and it'll ultimately pay out to you as dividends in years and years and years to come. These typically tend to be dynasty or legacy type assets, which you will leave stock in this asset to your grandkids, and they'll eventually take dividends from it and go from there.
But does that also, does it get included?
I'm not repeating the questions. I'm sorry, Rich. Is everyone hearing the questions? I don't want to spend a whole lot of time on it. I kind of just wanted to plant the idea, let you know that's out there, and move on. And really the pitfall. Don't get into, you got to know your bedfellows. You know who you're in with. Yes.
Does that fall into that gift that you can give?
It's not a gift. It's a true insurance premium. The same as you'd pay Mass Mutual for your premium for continuity, you'd pay a premium to this insurance company. It doesn't always work. It's a complicated set of fact patterns, but I certainly wanted to throw it out there and let you know it's out there. It's something there. Long-term care insurance is commonly deductible but overlooked. There are limits based on age. But if you are paying long-term care insurance and you do have an HSA, it's a perfect opportunity to take a deduction for those premiums. And that's something I see overlooked pretty often. Again, don't want to spend a whole lot of time on it, but just know that if you are paying premiums for long-term care, examine the deductibility. Pensions, there are lots of pensions, and all with different limits, all with different complexities. Some require actuarial calculations and pension administrators, some don't. Some require you fund them before the end of the year, before December 31st. Other before the tax filings, and others before the extended tax filing. So again, I just wanted to throw it out there that there are pensions that go, without getting fancy, you can deduct $53,000, $59,000 annually per participant. And the beautiful thing with a lot of these plans is that you can take the deduction in December, but only fund the thing 9 months later. So you're basically borrowing Uncle Sam's money for 9 months. So in addition to the created tax deduction and the investment components, you're also borrowing money for free for 9 months until the extension of the tax return.
So you have SEP IRA amount of $53,000 per person?
Yes, the SEP IRAs are limited to 25% of the wages, lesser of 25% of the wages, or 53. One interesting thing about SEPs, while we're on that quickly, is you can exclude employees on SEPs for up to 3 years. So it's nice if you're starting out to use SEPs because you can exclude employees for up to 3 years of hire and only then include them. So it's a nice, easy, administrator-free way to put away a pretty good amount of money. Disability insurance, where do you pay it from? Do you pay it from your corporation or do you pay it from your personal? And it's sort of an interesting set of facts. If you pay it from your corporation, the benefits become taxable should they be claimed. But if you pay it from the personal, where you don't get the tax deduction every year for the premiums paid, the benefits are tax-free. So we got your
overhead expense with your corporation and your disability from your personal. Make it expensive.
okay.
Can you repeat what you said?
He's taking the position that business continuity expense must be paid from the corporation, where disability should only be paid from the personal. I've seen it done other ways, but yeah. But just know the same thing's true with life insurance, where if you're paying it from the corporation, which you really shouldn't do, the proceeds would be an asset of the corporation and therefore subject to corporate level tax. Question?
Which one would you recommend in which situation?
Yeah, it depends on your circumstance. I don't want to give you too specific. We can talk offline. Let's talk about that offline, but you've really got to think about the issues. Yeah. Child dependent care, if both spouses work, you can typically take up to $6,000. Just a reminder that things like summer camp or daycares are qualify for this, typically not academic type settings. So not day school, but certainly nursery school or things like that would be. And summer camp is one that we commonly get to the $6,000 limit from. So that's usually where I go first. State income tax, just throwing it out there that you can be creative with state income tax deduction. Basically, the idea is that state income tax deduction is deductible, but you lose the benefit of that deduction if you're an alternative minimum tax. Alternative minimum tax is something that sort of pops out of nowhere sometimes, and depending on your circumstance, you want to do a projection at year end to see whether 1 year is going to be an AMT year and 1 year is not going to be an AMT year, and try and pay your state income tax in the year that's not an AMT year. I've seen circumstances where you've actually gotten benefits from paying state income tax late, subject to penalty, and still had a net benefit from the deferral by paying the tax in the subsequent year when the client was not going to be an AMT. So just to stress that you really should study the AMT calculation every year and figure out when you're going to get the benefit from a state income tax deduction and try and time your payments accordingly. But again, you've really got to study your own circumstance. I don't want to give you general advice on that. It changes even within the same individual client from year to year. So definitely study that. Refinancing points, with rates being so low and continuing to drop in spite of the Fed's efforts, I just wanted to make sure that people were aware of that your refinance points are deductible, not to be overlooked. Social Security, if you are a sole proprietor or you have an LLC, you're going to pay both sides of Social Security, and half of it does become a deduction to you. It's actually not a deduction, it's an adjustment on the face of the return. So just be mindful of that not to omit that. And there is some benefit there when you're doing that calculation in your head of the 7.65% is deduction for you. Amortization of bond premium is a very interesting issue. Basically, the way amortization of bond premiums work is, let's start with what a bond premium is. If you look on the bond screens right now, and you can buy a 4.5% yielding bond from your favorite financial institution, and the prevailing rate is only 2%, in order to get that 4.5% monthly or quarterly payment, you're going to pay a premium for that. So instead of paying $100 on the dollar, or $100 for $100 a face, you might pay $102 for the $100 a face, and then you'll get the additional interest payment monthly, so the net is back to the market rate. Let me try and say that again, because I'm not sure I was very clear on that. If the coupon on the bond is higher than the prevailing rate, in order to get that coupon, you're going to pay more than the face value for that bond. So you've paid what's called a premium. That premium can be handled two different ways. You can either amortize the premium and take the deduction in the amortization credit in every year until the bond matures, or you can have an increased basis and take a capital gain when that bond matures. So on paper, it sounds like those should be pretty similar. But if you take the capital step up, the increased capital basis, and take all of the benefit at the time the bond matures, you'll actually be getting a long-term capital gains benefit, which is typically 15 or 20%, against ordinary income, which is the characterization of interest income. Versus taking it annually, you're going to get a better tax effect, even though it's mechanically more difficult. I would just encourage you, if you have a bond portfolio of substance or size, to just make sure that your bond premium amortization is handled correctly. It tends to be a very sort of messy, complicated part of your 1099 that you're getting from your brokerage, and easy to omit and overlook, but there's a real benefit there. Legal fees paid to secure alimony is commonly overlooked. If people have spouses working in their practices at the time of the divorce, there's an opportunity for allocating portion of legal fees directly to the business. So just wanted to throw that out there, that certain fees associated with separation can, if the opportunity is correct, be deductible in one way or another. And when you're gifting at year end, so this is something that I talk a lot about in December, is gifting appreciated stocks. So this is it's really three benefits here, and I put together a little video here to re-engage everyone when it comes to talking about taxes, break up the presentation a little bit, frankly, pull up the video but while I talk about this. But it's basically you avoid taxing the gain, the charity gets more, and you get a larger itemized deduction. And rather than trying to explain this, I put together this video.
John, I hear from my friends that when making a charitable donation, it's better to give stocks than cash. Why is that so? I don't understand.
Yes, your friends are right. Giving stock means that you can avoid capital gains on your stocks and therefore be more efficient about your gift.
What do you mean?
Let's say you have a stock worth XX, but you bought it for Y. You will ultimately need to pay tax on this gain if and when you sell the stock. An alternative approach is to gift the stock, thereby avoiding ever having to pay tax on the gain.
But my portfolio isn't doing great this year. It's pretty much where I started from.
That's okay. It's not about your whole portfolio's performance, but rather about a single position that has done well. Even if just one position is ahead, you can gift that one stock and avoid that capital gains on that position.
But I like that stock. It's done so well for me. I can't imagine giving it away is a good idea.
Don't worry. You can gift the shares you currently have which have a low basis. That is a large gain. And go out and buy new shares of the same stock on the open market, and thereby resetting your cost basis. In other words, you can maintain your same economic position of holding 100 shares of X, but getting a higher basis so that when you eventually sell the shares, you'll have a basis much higher than you presently do.
Got it. So I'll gift my shares of Southwest Airlines, which have a basis of $11. Go out and buy shares of Southwest Airlines, which will create a new basis of $41. I avoid the tax on the difference between 11 and 41 forever. Brilliant! With tax rates so high, this is a significant savings. What does this transaction cost?
Typically, this transaction will be very inexpensive, but check with your brokerage firm. The transfer of the low basis shares will usually be free, and the purchase of new replacement shares with a higher basis is often as low as $9 per trade.
So what do I actually save?
If you have 100 shares of Southwest Airlines stock bought for $11 a share in 2010, and it's now worth $41 per share, you can sell your 100 shares for $41 each for total proceeds of $4,100 and pay tax of about $1,080, netting $3,020 in cash. Your $4,100 worth of stock became a $3,020 cash gift to charity. Here's the math summary. $41 market price, $11 basis, $30 gain, 36% tax, 20% Fed plus 13% CA plus 3.8% Medicare, tax equals $10.80. $30.20 per share net after tax available for gifting. Since you had 100 shares, that is $3,020. That is $3,020 versus $4,100 if you had gifted the shares themselves.
Wow, so by simply gifting the shares rather than giving cash, I'm able to give $1,080 more to the organization.
Sarah, remember these critical points. 1. Transfer the stock in kind, rather than selling and transferring the cash. This is an easy mistake to make and should be avoided. 2. In your written request to your custodian, be sure to ask them to move the stocks with the lowest cost basis. This ensures maximum benefit.
Thank you for explaining this to me. Now I understand what my friends have been telling me all along. Anything else I should know?
Yes, I'm not your CPA. I've explained in general the economic rationale for gifting stocks rather than cash. However, benefits differ based on each person's personal tax position. Please be sure to consult your tax advisor for specific advice regarding your own situation.
I thought it'd be a fun way to break up the presentation because taxes can be a little dry. But bottom line is, if you have any appreciated stocks in your portfolio, you should absolutely be giving that before cash. And it's really, really easy to do. Any of your brokerages have foundations associated with them. It can be done in literally 5 minutes online. And it saves you a hell of a lot of tax. It benefits the organization. It's really a no-brainer. And I would encourage you at year end when you're doing your gifting to do it through appreciated assets, not through cash. Cash is really the last thing to give. Okay, keep going there, Frank. Oh, something else. The sweat equity, the pro bono work we're doing for the Holocaust community. Congratulations. It's important work, and it's pretty sad that We have Holocaust survivors in our community who are literally hungry. But I commend this room for getting behind that. But the pro bono work you're doing there is not deductible. Doesn't mean you shouldn't do it, but that's not actually, it's non-reportable completely. From a tax perspective, it's a non-event. So definitely stocks is the way to go. Life insurance. I just want to focus here on calculating need relative to ownership, because we all think of life insurance as being tax-free on death, but that's not always true. If it's held in your own estate, if it's held in your own name, and you have a taxable estate upon death, that will be fully taxable. And it's very easy to miscalculate that, thinking, I'm a young dentist, there's no way between my wife and I, or my spouse and I have over $10 million of value. But actually, it's very likely that if you're buying 20 or 30-year term insurance, that upon death you'll have a taxable estate. And I would just encourage you to look out at the term of insurance before determining how to own that, whether it's in an irrevocable life insurance trust, which would keep it outside of the taxable estate, or hold it in your own name, or your living trust, which would include it in the taxable estate. Does that clear? I feel like that's something that applies to this room pretty widely. I threw an example up here very quickly. Someone who has a present net value of $2 million, that includes stocks, bonds, house, practice, whatever, and you assume you're contributing to that at $2,000 a month, which is a reasonable assumption for a professional, and you assume a 4% growth rate, and you're buying 20-year insurance, you're going to have a taxable estate before the end of that 20-year term. And that person would benefit tremendously by engaging their estate planning attorney, paying them a couple $1,000s. It's not a huge investment to get an irrevocable life insurance trust established and to put the ownership of the life insurance in that trust, and that would keep it free of tax upon death. So don't just look at the present value of your estate when making that computation, but really extrapolate out and say, what's this thing going to be worth, within the term of coverage? Frank, go ahead. Oh, I could do this. Sorry. Thank you. Yes, you do need a crummy letter. The premiums need to be paid through the use of a crummy letter, where you notify the participants or the beneficiaries that they have the right to withdraw. It's something that you're supposed to just put on file. But thank you. Position optimization. Every single time, without fail, that I take on a new tax client, I'm seeing position optimization completely overlooked. So let me tell you a little bit about position optimization. Position optimization says that if you've got multiple buckets of your portfolio, you've got an IRA, you've got a Roth, you've got a living trust, an individual account, you need to be strategic about which assets you put in which of these buckets. So I put some examples up here. The one that's easily overlooked and probably has the greatest benefit is holding foreign positions in a pension or retirement account is just a big mistake if you have any sort of option about that. The reason is because these foreign investments will throw off what's called foreign tax credits. So if you've invested, for example, in a European stock, and that stock pays tax to its local jurisdiction, it throws off a dollar-for-dollar tax credit, which can be used, in theory, against your U.S. income tax. However, if that asset is held in your IRA or pension, the benefit of that tax credit is completely lost. Speculative or high-risk positions, you really should go in a Roth. So if there's an opportunity to invest in some high-tech startup or some new dental technology company, consider using Roth money for that investment. Interest income is sort of not a very exciting topic these days with prevailing rates being so low, but it's taxed at ordinary income tax rates, so that's something you want to keep in your IRAs or retirement funds, whereas dividend-yielding stocks, which dividends are taxed at a lower rate, should typically be held in an individual account, because you want to actually take advantage of opportunities to pay tax at lower rates. That it's sort of counterintuitive, but if you can pay tax at lower rates, it's often a good thing. And obviously never hold tax-free munis in a retirement account, because the whole point of that is that the taxes they're paying, that they're paying you as an investor, are coming to you tax-free at a lower rate. But if you hold it in your retirement account, you obviously lose that benefit. I can't tell you Almost every new client that I see has more than one of these problems in their retirement, in their investment portfolio. And I would just encourage you to just look, hey, take a look at your pension, see what percentage of it is foreign. And is there a switching cost to moving that position? Not getting out of it, but simply recalibrating where that position is held and swapping the position with your individual account. HSAs are a no-brainer for most if it works for you. So interesting thing about an HSA is you get the deduction on the contribution. It's never taxed, as opposed to a pension plan, which you get the deduction on the contribution, but then it's ultimately taxed, hopefully at a lower rate, or maybe the grandkids will pay it ultimately with what's called a stretch IRA, something that I can talk about if this is of interest to you. Whereas an HSA, you put the money in, you get the credit for putting it in, and you never pay tax on it coming out, so long as you use it for medical expenses. Not everyone can contribute to HSA, so it's an interesting question you should look at. You can also use HSA premiums typically to pay for long-term care insurance premiums. So if the opportunity is there, it's interesting. So I just wanted to make you aware of that. And in theory, you can hold all kinds of things in an HSA. In full disclosure, I've never actually seen anything other than cash be held in an HSA, but having studied the code, if you can get a reasonable sum into the HSA, you should be able to actually invest the money, and all of the growth should be available for you to pay for medical expenses. There's no time limit on the disbursement. It's there forever. So it's an interesting thing. C Corps. C Corps are really, really interesting. Great opportunities. It's great to see C Corps used when clients have medical expenses that are not insured. Two great examples of that are either alternative treatments that are not going to come through medical insurance, that are not going to be covered by medical insurance, or more commonly, we see fertility treatment being huge expenses, which are not covered through medical insurance, obviously. And if you can set up a C corporation, you can also set up what's called a medical reimbursement plan. Medical reimbursement plan would allow all medical expenses to be reimbursed as business expenses to the employee. Pretty interesting. So you can take very, very high medical expenses, and if the circumstance is right, create legitimate deductible business expenses out of those. So definitely the younger crew here, please make sure your friends know. I mean, fertility is an issue that affects a huge portion of our population, and if this is a good way to structure the expenses to create a little bit of ease on that painful process, it's something that people should know about.
So when you do that, do you have to provide that to all the employees of the company?
That is true. There is a non-discrimination issue, so it doesn't work. I did throw that up there. Must cover all employees, non-discriminatory. That's true. Now, the question was, do you have to cover all employees? Yes. And the other thing is it is a reimbursement plan. So if examined, the money has to go as follows. The employee must incur the expense, and then the corporation has to reimburse the employee. The corporation cannot pay the provider directly. Just careful on that. Easy to screw up the order there, and you do put the whole deduction at risk. But, you know, we go back to Judge Learned Hand's second slide I showed you, where you can create your situation such that you can have a C corporation employing that one employee, which is of issue, and work that way. It has to be a different business line. It has to be a truly segregated population. So you can't just take, your one employee who's sitting at the front desk in your practice providing all the similar services as the person next to him or her, and that person's the employee of a new corporation. That wouldn't work, obviously. But if you, for example, created a PR firm, I don't know, and that person's role was marketing and PR, and you could legitimately segregate that person from the rest of your population, that's a possibility where you could provide insurance to just that one person and not violate the non-discrimination rules. So again, I'd want to look at your facts and circumstances and make sure that it was structured accordingly, but there's nothing in the rule book that prohibits you creating structures which enable the deduction. So that's the key.
What if you have an S corp?
You cannot. It's got to be a C corp. C corps are generally a less preferred vehicle for a number of reasons. This is probably the only reason you'd want a C corp. This, and if you had a foreign investor who you wanted to take capital from.
Yeah, I don't think as Dennis we can have a C corp.
You can have a C corp. You can't have an LLC. You can have C corps. Yeah. So again, I'm not sure this is going to apply to a whole lot of people in the room, but it is good to know about. That's my presentation. I went through that pretty quickly. I was expecting more questions and more issues, but